You say that the non-tradables inflation has been the lowest since the Depression. Sorry, the tradables inflation lowest since the Depression, and that the currency has been significantly higher than you expected. Doesn't that show that you've been running monetary policy too tight for most of that period?
No, I don't think so. If you look at the economy in the last 5 years, growth has averaged around 3%. That's been above trend for this economy. If you look at employment growth, it's also averaged around 3% over that period. Now, the downside of that is there's low productivity growth, or zero, or even on some measures negative productivity growth. But you've seen output growth and employment growth above trend. And it's hard, I think, to make the argument that that's an indication of monetary policy being run too tightly, because monetary policy does affect output and employment growth. There are other factors involved in all of that, of course, in terms of population increase and construction backlogs and all of that in terms of that growth story. But you're always going to be facing trade-offs around aggregate demand growth in the economy, price pressures. You're going to be forecasting a lot of things that you find extremely difficult to forecast about commodity prices. I mean, for example, we had a 70% decline in oil prices. We had a 75% decline in whole milk powder prices. The ability to forecast those are highly difficult, to say the least. And you're also looking at asset prices when you're looking at interest rate decisions. You're also saying to yourself, well, where's the housing market? What's that going to do to house price inflation? So you're always making these sorts of trade-offs when you're thinking about monetary policy settings.
So given that, and given that inflation is beneath the band rather than above the band, would you have taken that 5 years ago if someone said, look, Graeme, in 5 years' time, given what you've just said, that's going to be what the situation is at your last press conference? Would you have taken that?
Well, I think if you go back for some period, you'll find that inflation was at the high end of the band. It was around 2.9%. It had been averaging that. And that was one of the reasons why we put the emphasis on the 2% midpoint. But we also knew that monetary policy is enormously difficult to calibrate. There's judgments about lags and transmission mechanisms. And so that's why we always referred to over the medium term and on average and those sorts of concepts. But look, if you say, by and large, has the economy performed well in the last 5 years in terms of output and employment growth? Has house price inflation come down from 15% to just over 2% at this point? And is core inflation running at around 1.5%? And given that you're going to have volatility in headline inflation because of tradables inflation, then I think that's a pretty good outcome, and the central bank, can take some credit in those outcomes. It's not the whole story, far from it. There's an awful lot of other things happening, but I think the Reserve Bank has been pretty successful in many respects.
Your sort of cautious approach this year, I think, has surprised some commentators, and I'm wondering. I mean, and indeed, the data seem to have borne out and justified your stance. Wondering whether your experience earlier on in your tenure, when you raised interest rates, has that had any influence on your current sort of approach to policy? So specifically, I'm asking whether, with the benefit of hindsight, you feel that you tightened too quickly at the start of your term, and whether that's influenced your current thinking on monetary policy.
If you go back to that episode where we did raise rates, you had a situation where the terms of trade were at a 40-year high. Oil prices had been very strong in the lead up to that. They were remaining around $110 a barrel, where they'd been for the last 4 years or so. Whole milk powder prices were very high. The market was expecting a tightening. They were pricing that in. The terms of trade, as I say, were at a 40-year high. The IMF, like ourselves, was forecasting a positive output gap. And I think it was a reasonable judgment on the information that we had available and what the market was pricing and what other commentators were expecting, that we did tighten monetary policy. We tightened it 4 times. What we didn't anticipate, and I think is, it's fair to say, I think that it would be very hard for central banks to forecast commodity prices. We didn't expect that the oil price would be on a downward track that would end up from $110 a barrel, that would end up at $28 a barrel in terms of Brent crude. That whole milk powder prices would go from, say, $5,200 a metric tonne to $1,590 a metric tonne at the bottom of that thing. So I think the test is, do you make appropriate decisions based on the information you have available at the time? And then if that information changes on you, do you then make appropriate decisions and modify your views? So we tightened 4 times. We then removed the tightening bias, and then we cut 7 times. So if you ask those tests, I'm comfortable that the bank meets those tests.